Okay, so let's now look into another important thing is, and an important decision for most investors is whether we should go with the crowd or we should go against the crowd, whether we should follow the trend or be contrarians. So let's watch our short video again to give us some background. Let me just check if okay, the sound is on. Okay, let's then watch our...
Welcome to The Explainer. Today we're jumping right into one of the most fundamental debates in all of investing. Do you ride the wave with everyone else, or do you bet against the current? Yep, we're talking trend following versus contrarian investing. This sentence, man, it just perfectly captures the core problem, doesn't it? You want to find that game-changing idea, that stock nobody else sees, but that fear of being wrong and being out there all by yourself is incredibly powerful. It's a constant tug of war. And this tension, this pull between your own conviction and the need for confirmation is really the starting point for two very different investment philosophies, two seemingly opposite paths that investors head down.
So, investors are stuck with this paradox. Follow the market's momentum or trust your own gut? Let's explore that first path, betting against the crowd.
Right, so this is the path of the contrarian. This is the investor who looks at the stampeding herd and very deliberately decides to walk in the opposite direction, making a bet that the crowd has it all wrong.
And this isn't just about disagreeing for the sake of it. Not at all. Contrarian investing is a systematic hunt for value. It's about finding opportunities where herd behavior, whether it's total panic or just wild euphoria, has pushed a stock's price way out of line with its true worth. The goal is to jump on that gap before the market corrects itself, which is why it's often a short to medium-term play.
So how do you actually do this systematically? Well, a true contrarian is on the lookout for two very specific mismatches. First, they're looking for diamonds in the rough, companies with really low ratings that are actually fundamentally strong. And on the flip side, they're looking for ticking time bombs, companies everyone absolutely loves that are, well, fundamentally weak. That signals some dangerous overconfidence. But a good contrarian needs proofs, right? You can't just go on a hunch. This is where you look for deeper signals to back up your theory. Take the synthetic multiple. Just think of it as a dynamic, all-in-one measure of a company's valuation. If you see that valuation falling while the company's performance is still solid, that's a powerful sign that market sentiment, not reality, is driving the price down. Okay, so that's one way. Now for the complete opposite approach. Instead of fighting the current, you find the strongest one and you ride it.
If contrarianism is all about market psychology, trend following is more like market physics, specifically inertia. The core belief is that powerful forces are already in motion and that what's strong tends to stay strong. The focus here isn't on short-term fads, but on finding and joining in on these durable, long-term trends.
But how do you separate a real trend from just a temporary blip? Well, the key is a disciplined, multi-step analysis. You don't just look at what's hot this year. You look for industries that have been at the top for multiple overlapping 3-year periods. That consistency is what signals a durable trend, and only then do you drill down to find the best stocks within that winning industry.
This funnel approach is absolutely crucial because it enforces discipline. It stops you from getting caught up in the hype around a single hot stock and instead forces you to confirm the strength of the entire underlying industry over time. It's all about betting on a rising tide, not just one popular boat.
So we have these two powerful logical strategies that are in direct opposition. One says buy the losers, the other says buy the winners. So what does the actual data say? Who really comes out on top?
This is one of the oldest debates in finance, right? The battle between momentum and mean reversion. Does strength just lead to more strength, or does everything eventually snap back to the average?
Well, when we look at the data, we see a pretty stark difference in what happens next for the market's biggest winners and its biggest losers. Let's break down these numbers.
The findings here are fascinating. Look at the losers. A full 50% of them, half, rebounded strongly in the very next quarter. But the winners? Only 30% kept rising. The vast majority, 64%, just faded back into the middle of the pack. The takeaway is pretty clear. Betting on a loser to bounce back seems to have better odds than betting on a winner to keep winning.
So why does this happen? It's because markets tend to overreact. Losers get punished way too harshly, creating a kind of elastic band effect that snaps them back. And winners get so overhyped that their valuations just can't possibly meet expectations. So the crucial point here is that relying exclusively on one strategy is a flawed approach. This data really suggests that picking just one strategy is a flawed approach. And this brings us to a more sophisticated way of thinking. What if the best investors don't choose one or the other, but instead they synthesize both? So after all that, which strategy is better, the contrarian or the trend follower? Well, the surprising answer is, that's the wrong question.
The real question isn't which one wins, but which one fits the specific market context and your goals. A contrarian approach is powerful when market sentiment is clearly overshot reality, but you need to be able to stomach the volatility. Trend following is great for capturing major structural shifts, but it demands strict discipline and clear exit rules.
And this is the core insight. The smartest investors don't choose a side, they choose a sequence. They understand that both strategies are just tools, and they use them at different stages in the life cycle of a single investment. So here's the playbook. Phase 1, entry. Use trend-following data to get into a strengthening trend early on. Phase 2, holding. Don't just ride the wave blindly. Constantly monitor the company's fundamental quality to make sure the thesis is still intact. And phase 3, exit. As the trend matures and the crowd becomes overly confident, you use contrarian indicators to know when it's time to sell. They use momentum to get in, fundamentals to stay in, and contrarian signals to get out. And it all comes down to this simple but powerful mantra: enter with the trend, exit against the crowd. It's about blending the best of both worlds. The real skill isn't being a contrarian or a trend follower, it's knowing when to be which. So the question for you isn't which tool is better, but are you using the right one at the right time?
Okay, so in that, let's see how we can then or how we should combine momentum at the entry and contrarian at the exit. Okay, so let's choose here the momentum strategy, which we have here in our tab with strategies. As you see, the back test didn't show momentum being one of the best. Was still positive, but was one of the best. Let's see how momentum would work for France. That's the country we have selected here. And let's look at the given period. Okay, let's select first of all industries, and let's look at the past 3 months. Which should go to, okay. So how would this strategy perform in the recent past? Not too bad, but not too well. You see, it has a return of 0.6. The market was worse, -2 points. So it was still positive, but not as good as the other strategy. Now, was this would this be a good strategy to start, or if you want to explore the moment? Well, we don't really know unless we would go back to the past, find a period similar to this one, and see how it reacted after in the out-of-bound period. And if we found a better period, maybe it would be worthwhile. Another way of testing this strategy is, of course, to change it slightly. Let's imagine instead of selecting all the 153 industries that we have, we're just going to select the top 10 industries. So this way would basically, okay, still keep the betting on a momentum strategy, but we would test it for just those sectors that would be doing best in the current period. So let's just do this for the 10 sectors, and let's run the screen again to see if it improves or not. As you can see, betting in the best sectors actually worse. That would be have worse the strategy. And why so? Well, because typically there is some sector rotation among stocks. So if one stock, one particular sector has been moving very fast, it very likely will be slowing down or even decreasing, while another sector will take over. That's why it is important, let's say, for instance, to go back to our market section, and let's see if we want to find the best strategy, the best industries in the recently. Okay. And why it's not showing all of them? There must be something that I'm making it at sectors. This top if I list all of them, I get all of them, I think. Okay, medium. Okay, like this, I have all the industries here, the 150 something. Okay, if I look at the past quarter, which was the one we are considering here, I can see that oil and gas was really the top performer, you see. But we see that in the previous period, the oil and gas industry was actually one of the worst performers. It didn't have a very good performance. And overall, if you look at the various at the 3-year period, you'll see that a lot of the extremely good performance industry-wise, you see, they are all in the oil and semiconductor period. So what can we expect after a very good run in the oil industry? Will it continue to run very well, or will it have problems in the near future? So again, if you look at these dark spots here, we can see how we can try to get some idea of how the various industries rotate in terms of performance. And if you want then to go back to our strategy, where are we with our strategy? If you want to go back here, I don't know if we were here or there. Let me see. Okay, we can actually come here and select industries. We remove all of them, and we then select some industry. Let's say I want the oil industry. And I select all of these related to oil and so on. What if on the other hand, I want to be a contrarian? Let's say I want to have all industries except the oil sector industry. So you do just the opposite. I select all of them, and then I come here and unselect everything related to oil. Okay, so in this case, I would be okay. I need to. All right, and if I run now the screen, excluding the oil sector, you see how my performance improves a little bit. And if I'm right in considering that in pursuing a contrarian strategy, so I want to bet that the this oil run is going to end very soon. So I'm not going to buy oil now. I'm going to sell my oil positions and buy some other industries. I can look here and see which industries are have provided better results and select those industries. So you see, I can always mix, and I should always try to mix the momentum, take advantage of the momentum, and use my analysis of the momentum to then consider which sectors I should exit. Okay, so I can do this for these companies, or I can use as we have in our platform, a specific program that tries to do that forecast for us. So basically, we'll look at that program when we do the due diligence analysis, but we also have a program that we can use to give us some guidance in terms of what is the near term expectation in relation to some specific stocks. So we can also use that. Now there is other types of tests that we can see, and it's interesting to consider. Let's say, for instance, how should we trust analysts or not? Let's here I think I'm going to move to the US because we have more information in the US than in France. But let's see that I want to, so I have all selected now, okay. And let's see that I want to build a specific screen that will let me compare a contrarian strategy. Let's say that I select here the analyst. No. Oh, okay. Here I have the analyst consensus recommendations. Okay, I have here the recommendations of the analysts. Let's say the analysts are very bullish, so I'm going to put this between greater than 90. So I'm going to consider the analysts that are bullish in relation to the stocks they are bullish, and then I will add here an alternative filter, which is to use the one of our ratings that can be contrarian. Let's say what I want to do here is to find stocks that are very popular among analysts, but not popular with SADIF. So that I can take a contrarian position if I trust the SADIF to be better than the consensus of the analysts. So I'm going to then try to put some restriction here. I want the stocks that are maybe 30 is a bit exaggerated, but let's say 50%. And let's put here the weighting. I will weighting. Okay, so I've got here a list. You see, if I wanted to go against the analyst opinion for this period of time, I will be in trouble, you see, because I'm going to select those stocks. If I were going to be contrarian against the analysts, I would be in trouble. Okay, so because I picked up their top picks, and then the ones that the analyst, the SADIF had a bad rating, and I would be in trouble because I would lose 11% against a market run of 10%. So you see, or I can do the other way around when testing, which would be to select those stocks that have a very low rating among the analysts, let's say less than 50, but have a strong rating at the SADIF, let's say 80% here. And let's try this strategy. Okay, this would be, of course, even worse. So that means that if we are too bullish in relation to a given stock, but the analysts would be very bearish about those stocks, I think they would win, because this would provide bad results. Now let me, in the case of SADIF, we can actually use different ratings. Why? Because this is the overall rating that usually only produces good results for by eliminating the big ratings for reasons that I will explain to you later. But let's say that I put here 100. So I just drop the top 10% and see how the result changes. Doesn't change much in this case. So didn't change much. Sorry, I was doing the wrong thing. I didn't realize that I changed. So I wanted to. Okay, now that's fine. I wanted to check those stocks that are where in relation to which the analysts are bearish against those that the SADIF is bullish, and so this would be right. Let's start the difference, which is, for instance, that stocks that are overvalued. Okay, so you can want to be, you don't want to buy stocks that are overvalued because you fear that they have already run their time. So you're going to use here the SMK, which is on our synthetic multiple, includes the three main multiples, and let's see that I select here the stocks that are in the top 20%. Okay, and now I want those stocks that have valued, that are still very valuable. I may even increase this to 90% if I want. And now I want those that don't have a very good financial position. So I'm going to choose here a different rating. Let's say SMF. Okay, where is it? Okay. So if I have a stock that is still very high valued by the market, but has very poor financials, let's say is in the bottom 30%, what would be the result of this strategy? Okay, this would, of course, give us a very good return. You see 15% against the 10% in the market. It completely changed. So this mix of contrarian strategies could be a positive result. Of course, these results are only valid for the last 3 months. And as I said in the beginning, this will have to be tested against similar periods or even longer periods. And we could run, of course, here a back test like we did before to see if really if this strategy works for a longer period of time. You see, so you could ideally I should go here and back test it. So we're not going to do it now because you don't have the time. But this gives you the main thrust of this debate between being a contrarian or being a trend follower. As we saw here, you can be both. The important thing is that you back test correctly the strategy that you want to follow. Check if it works for different periods of time. Check it if it works in the past and in out of bound periods. So even when you test the past, you have to test 2 periods. And that will give you more confidence in terms of what you want to do. Okay, now let's move to the next topic and to the next short video, which is how we are going to, after we have gone through this back testing, contrarian and trend following analysis and so on, we've got some ideas. So we generate some ideas. Got some. Let's imagine that our ideas are these ones here, for instance, and then we need to see what we're going to do in terms of creating a watch list, which is our next topic.